In today's lecture, we are going to study about admission of a partner. So, in the previous class, we have studied what is partnership actually and what are kinds of partners. And next, we are going to study in this part 3 admission of a partner. So, admission of a partner means whenever a new person is going to admit in a partnership firm, that is nothing but an admission of a partner. So whenever this person, a new person is going to admit in our partnership firm, whatever the old partnership firm we have made before, suppose before A, B, C and 3 are the partners, for example, and now they are going to admit D partner. So whatever the profit sharing ratio or whatever the losses sharing or whatever the dues are there, that will be limited to that previous partnership only. It will not be coming or it will not be continuing by admitting this partner. Means whenever a new partner is admitted, so whatever the old one is there, it will be removed and a new one is formed or new one is uh, reconstituted in order to admit a new partner. So if we see here, admission of a partner is one of the modes of reconstituting the firm under which existing partnership comes to an end. Whatever the existing partnership will be there, that will be comes to an end. Means here, as a new person is entering, new profit sharing ratio will be there, and some of the profits they have to profit sharing ratio they have to sacrifice. The old partners have to sacrifice for the new partner. Means it is one of the modes of reconstituting the firm. Whatever the partnership firm is there, existing one, it must be reconstituted in order to admit a new partner. Okay, so admission of a partner is one of the modes of the reconstituting the firm under which existing partnership comes to an end. So as a new person is admitted into a partnership firm, the partnership firm will be reconstituted again. Means different profit sharing ratios will be there, different profit mm, and losses will be there, different duties may be assigned, like that. So whenever a partner is admitted, the incoming partner or the newly admitted partner will receive the share equal to the sacrifice made by the existing partners, and this new partner will compensate for that to the existing partners by bringing goodwill or premium for goodwill. So, as the new partner is admitted into a partnership firm, whatever the existing partners are there, what they will do, they will sacrifice some of their profit sharing ratios. For example, A, B, and C are there. So, they are sharing profits like um, 5 to 2. A is profit sharing ratio is 5, B's profit sharing ratio is 2, and C's profit sharing ratio is 2. So what they have to do, they have to sacrifice. So they may sacrifice equally or they may sacrifice like more or less. So for example, A may sacrifice 2 of his profit sharing ratios, B may sacrifice 1, and C may sacrifice 1. So like that, they will share their profit sharing ratios or they will sacrifice their profit sharing ratios. So whenever they will sacrifice their profit sharing ratios, who is the new partner who is taking those profit sharing ratio, what he has to do, the new partner will compensate for that to existing partners by bringing some goodwill or premium for goodwill. Okay, some amount of money like that he has to bring. So that is nothing but admission of a partner. So now let us see what are all the adjustments to be made on admission. Whenever a new partner is entering into a partnership firm, there has to make certain adjustments in our firm. So what are all the adjustments? Calculating of new profit sharing ratio, and next accounting treatment of goodwill, and next adjustment of revaluation of assets and reassessment of liabilities, and next adjustment for reserves and accumulated profits, and next is adjustment of capital. So now let us see detailed explanation of this. So first one is calculating of new profit sharing ratio. So whenever a new partner is entering, so the profit sharing ratios of the existing partners will also be changed. So new profit sharing ratio for everyone will be given. So new profit sharing ratio means what? New profit sharing ratio is the ratio in which all the partners, including the new partner, will share the profits or losses of the firm. So new profit sharing ratio is nothing but whenever a new partner is entering into the firm, so different sharing ratios, as they have sacrificed some of their shares to the new partner, so their ratios, profit sharing ratio will also be changed. So that is nothing but new profit sharing ratio will be uh, given to each and every one. And next one is sacrificing ratio. So as whenever a new partner is entered, they will sacrifice some of their profits. So that is nothing but sacrificing ratio. So the ratio in which the old partners agree to sacrifice their share of profits in favor of the incoming partner is called sacrificing ratio. So as I've said before, so whenever a new partner, D partner, is entering into a partnership firm, A partner has sacrificed two of his share, and B one and C one. So that is nothing but the ratio in which the old partners agree to sacrifice their share of profits in favor for which partner? For the incoming new partner. So that is nothing but the sacrificing ratio. So a new calculation of new profit sharing ratio must be done. First adjustment. So for that sacrificing ratio and next new profit sharing ratio we have to do in order to calculate the profit sharing ratio. So this is the first adjustment we have to make whenever an admission of a partner is uh, done in the partnership firm, or a reconstitution of partnership firm. If it is done, we have to do this first adjustment. And now let us see the second adjustment. So second adjustment is what? Accounting treatment of goodwill. So what is goodwill actually? So I've said whenever the existing partners are sacrificing their shares to the newly entered or newly admitted partner, so he has to compensate something for their sacrifice. So that is treated as an goodwill. So goodwill may be in the form of a premium or in the form of an asset or anything. So goodwill is a way for compensating old partners for the sacrifice made by them on the admission of a new partner. Okay, so whatever the sacrifice have they have made for the admission of a new partner, so for that a goodwill is like a way of compensating, means paying something in return for them or compensating them for the sacrifice they have made. That is nothing but goodwill. So next what we have to do, we have to make an accounting treatment of goodwill. So why they have given accounting treatment of goodwill? Because goodwill may be in the form of money, or in the form of cash, or in the form of assets, like that. So the accounting treatment must be done for the goodwill. So sometimes what will happen, goodwill may be paid privately, means it is like it will not be disclosed in financial statements also, like that. So the accounting treatment of goodwill must be done in the next step. Whenever a new partner has admitted, whatever the goodwill he has brought, whether it is bought in the form of a cash, whether he has paid privately, or uh, did he bring in the form of premium, or whatever the thing, whatever the form he has brought, according to that the treatment will be done in the accounting process. So that's why the second step is accounting treatment of goodwill. And next one is adjustment of revaluation of assets and reassessment of liabilities. So adjustment of revaluation means recorrection of assets, and a reassessment, again assessing of the liabilities. So this is the third step. We have to make an adjustment whenever a new partner is entered. When a new partner is admitted, it is to be checked that neither he has not benefited by appreciation of value of assets or reduction in liabilities. So whenever a new partner is admitted, so what we have to do, we have to check that whether he is suffering because of the depreciation in the value of assets, or whether he has increase in the value of liabilities. So everything must be in the balanced format. Neither he should not suffer because of depreciation, nor he should not get increase in the value of the liabilities. So keeping this aspect in mind, the assets and liabilities are revalued at the real value on the day of the admission. Okay, so this is nothing but adjustment of, so adjustment on account of revaluation is done through the revaluation or profit and loss adjustment account. So whenever we do the uh, uh, accounting process, so uh, whatever the profit and loss adjustment, revaluation or profit and loss adjustment account will be there, in that we will do this revaluation of assets and reassessment of the liabilities. Okay, so revaluation account is an nominal account. Therefore, if so what it is, revaluation account is an nominal account. So if the credit balance is in excess of the debit balance, it means it is profit. Whenever a credit balance is more than the debit balance, it is considered as profit. And if debit balance is more than the credit balance, it is shown as a loss. Okay, that is nothing but adjustment of revaluation of assets and reassessment of liabilities. And next one, this is the third step. We have to make adjustment whenever a new partner is admitted. And next one, adjustment of reserves and accumulated profits. So whenever a new partner is entered, so from then his admission is done, the new profit sharing ratios or new things will be formed. Whatever the old profits, whatever the old losses or the reserves will be there, it must be ended to that part only. Means it is limited, or it is um extended to whom it is extended to, it is extended till for the old partners itself. So whenever a new partner is entered, he will not be liable for the profits, or he will not be liable for the dues, or he will not be liable for the losses of that old partnership firm. So that adjustment of reserves and accumulated profits we have to do. So at the time of admission of a new partner, if there is any general reserve, so we will keep some reserves for the future purpose. No, general reserve and reserves and surplus, or the balance of profit and loss account appearing in the balance sheet, it should be transferred to the capital accounts of the old partners in their old profit sharing ratio. So it is transferred to whom? It is transferred to the capital accounts of old partners, so to the old partners in their old profit sharing ratio. So it may be reserves or profits or losses, whatever it will be there, it is extended to whom? It is extended to the old partners only. So that is that's why these are adjusted to whom? These are adjusted to the old partners accounts in their old profit sharing ratio. So this is the fourth step they have to make when a new partner is admitted. And next one is determination or adjustment of capital. So this is the final step, like finding out or making adjustments for the capital. So sometimes at the time of admission of a new partner, the partner may agree that their capital should also be adjusted so as to be equal to their profit sharing ratio. So for that purpose, a different adjustment capital will be there. And if new partner's capital is not included, we have to find out in a different way. So that's why there are two steps, two different types in order to find out, in order to determination or adjustment of the capital. So first one is adjustment of old partner's capital on the basis of incoming partner's capital. So sometimes what happens, at the time of admission of a new partner, So they may agree that their capital should also be adjusted in order to be equal to their profit sharing ratio. So at that time, this adjustment of old partners capital on the basis of incoming partners capital, this kind of process they will use. And next one is calculating the capital of incoming partner on the basis of old partners capital. So this step, so these are two steps or two types of procedures they will follow, a partnership firm will follow in order to determination or adjustment of a capital. So final step, this is the final step in order to find out the capital of a partnership firm. So first step, what they when a new partner is admitted, what they will do. So admission of a new partner is nothing but whenever a new partner is admitted, so whatever the old partnership firm will be there, it is removed and a new partnership firm is reconstituted with the existing partners and the new partner. So in order to admit a new partner or admission of a new partner, whatever the adjustment they have to do, these are in these five steps. First, what we have to do, we have to calculate a new profit sharing ratio of olds and olds and new partner. Next, accounting treatment of goodwill, and next adjustment of revaluation of assets and reassessment of liabilities, and next one is adjustments for reserves and accumulated profits, and then adjustment of capital. Okay, so these are the adjustments we have to do whenever a new partner is admitted into a partnership firm. Okay, so in the next class we will see the next topic. Okay, so if you have any doubts, you can comment in the comment section below, so that I would like to clarify your doubts about this topic. And if you like this video, please like the video. And if any of your friends are preparing for net set or JRF exam, please do share. It will be beneficial to them. And please subscribe to my channel, so that uh, if you are studying these topics, so that you will be able to get my videos whenever I do upload the videos in the channel. Okay, thank you.